Hey everyone, and welcome back. Today, we're tackling one of the most important topics for any serious trader: understanding the battle between smart money and retail behavior. If you've ever felt like the market moves just to hit your stop loss before reversing, this lesson will show you that it's not a coincidence, it's by design. Here's our game plan. We're going to define exactly what smart money is, contrast it with typical retail behavior, and dive into concepts like liquidity traps and market psychology. We'll break down how the big players actually operate, and most importantly, how you can start avoiding common retail mistakes and begin thinking like the institutions. So, first up, what is smart money? This isn't a mythical creature. Smart money refers to institutional traders, the big players like central banks, commercial banks, hedge funds, and large investment firms. These are the entities that truly drive market direction. They have massive capital, superior information, and advanced technology that the average retail trader simply doesn't. On the other side of the trade, you have retail money. That's us, individual traders using our personal accounts. There's nothing wrong with being a retail trader, but our collective behavior, which is often driven by emotion and herd mentality, creates predictable patterns in the marketplace. And smart money uses these patterns to their advantage. So, how do they move the markets? It all comes down to liquidity. Smart money needs to fill huge orders without moving the price against themselves. So, they can't just buy a massive position all at once. Instead, they engineer price movements to areas where retail stop losses and market orders are clustered. They might push price down temporarily to trigger a wave of selling, allowing them to accumulate their long positions at a cheaper price before a real rally begins. This is what's often called a stop hunt or liquidity grab. This is where the behavior gap becomes crystal clear. Let's look at typical retail behavior. They chase price after a big move has already happened. They buy at the top out of FOMO and sell at the bottom out of panic. They trade emotionally, without a clear plan or confirmation. Now, contrast that with smart money behavior. They wait patiently for liquidity zones to form. They literally trade against these emotional retail reactions. They scale into positions gradually. They operate with precision and immense patience. This difference in behavior creates the traps we see all the time. A classic example is the false breakout trap. Price breaks below a key support level. Retail traders see this break and jump in to sell, thinking the downtrend is continuing. Their stop losses are stacked just above that broken support. But then, price reverses sharply, hunting all those stops, and rockets higher. The retail traders who just sold are now stopped out, while smart money, who was buying the entire time, rides the move up. You can think of this as a three-part cycle: accumulation. Smart money quietly builds its position while the market is quiet. Manipulation. They engineer a sharp, false move to trigger retail stops and liquidate weak hands. Distribution. Once price has moved in their favor and reached a target, they begin to distribute, or sell, their position to the retail traders who are now caught in FOMO. The tools and mindset are completely different. Retail often relies on lagging indicators that confirm a move too late. Smart money focuses on price action, liquidity, and information. The psychological gap is massive. Smart money operates on logic and discipline. Retail is often driven by fear and greed. So, how do you break the cycle and start thinking like smart money? First, identify liquidity zones. Where are the retail stops likely clustered? Second, wait for the manipulation. Don't trade the initial break. Wait for the price to show its hand with a reversal. Third, trade the reaction, not the impulse. The key takeaway is this: smart money moves the market with intent. Retail behavior provides the liquidity they need to do it. When you learn to recognize this pattern, you stop being the target and start trading with the flow. To put it simply, when you learn to trade like the institutions, you stop being the liquidity and you start profiting from it. That's all for this lesson. Thanks for watching.